Welcome guys, welcome to another episode of Funds की बात ICICI Direct के साथ. Today we have Mr. Shridatta Bhandwaldar. He is the head of equities at Canara Robeco Mutual Funds. Sir, it's an absolute pleasure hosting you.
Thank you for having us on the show. Thank you.
Yeah. So, sir, just going through your profile, you are also an engineer turned fund manager, like a lot of people during that year. So, could you just help us out with your journey? How did you? Is this what you always wanted to do? And then we can dabble into our discussion for equities and all this stuff.
Sure. No, it's not that I earlier was clear that I wanted to do this. I did my engineering from a town in Maharashtra, Aurangabad.
Okay.
And then I came to Bombay for doing my MBA. So when I was in Sydenham, actually during that period, I got a lot of interest at first in economics. I used to read extensively, and as I started reading a lot of that stuff, then I got more interested in markets, and I thought this is one place where probably effectively what you do is, and this is what I read in one of the book at that point in time, and then which has been my experience over a period of time. This is a place where you don't have to be smart. You just have to be smart enough to actually bet on the best people in the industry. Right. This is a platform which allows you to actually play on the strength of the best companies, best products, best managements in the country.
Absolutely.
That's when I actually got interested in equities. And then for last 17, 18, 19 years, I have been in market only. First, I spent about 5 years on institutional research side. And then last around 11, 12 years, I've been basically asset management side. I have done, frankly, all forms of money management. Initially, I started with long short hedge fund. Then I did long only pension fund. And then for last 7.5, 8 years, I've been with mutual fund.
Okay, so basically you've covered the entire circle, if we can say in that
I have covered
way.
all forms.
Yeah, so my first question to everybody, and I think since you have seen the entire cycle, is we are in the all-time high territory right now, and in these last 15 years, 20 years, we have seen a lot of all-time high territory. We have seen low territory as well, 52-week low or something of that sort. But right now, what do you think when the market is headed? And also, if somebody wants to enter the market fresh at this juncture, he'll have a lot of questions. Is this the right time to come in? Geopolitics, a lot of stuff are happening. So what would be your, how would you place your bets on the market right now?
Sure. So when you're looking at market today, and before forming a view about the future, you should always look at what has happened over the last few years. Okay. And that context becomes very, very critical for you to form a view. So when you look at the context, there are good things and there are bad things. And it's always there, but you have to weigh them and then say, okay, which is likely to actually play out more than the other. So when you look at current context and when you take a backdrop of last 3, 5 year, 10 year, both domestic and global, there are two themes that emerge. Yeah. Okay. One is post-COVID, with the excesses that the developed market has done, yeah, you are probably in an environment where the complex global environment is here to stay, which means you are going to have probably a little bit of growth moderation, yeah, because fortunately, unfortunately, we did not experience during COVID despite so much of trouble because of the money that was thrown at the developed market. You are likely to have relatively higher interest rates as compared to last 5-10 years. And from a contextual perspective, you are going to have growth moderation as actually interest rates are higher and as, yeah, basically developed markets start tightening the liquidity, which, right, they are underway. On top of that, unfortunately, we have these two wars which have broken out, which is actually creating additional growth challenges, yeah, because ultimately all these things impact the demand at some level. Yeah. So you are in an environment where the global is far more complex, probably weak, and at the same time we have domestic, which is probably the best that you have seen.
Yeah.
So we have a domestic where the 2 or 3 critical challenges that we were facing as a economy over last 10 years, if you take say 2013 to 23, yeah, the biggest challenges that we were facing is that effectively you had corporates and you had banks which were going through a very, very rough, yes, patch. And that was an outcome of previous excesses. As the banks and basically corporates have delivered through last 5-7 years, now you are at a stage where you have 4 or 5 factors going for you. Yeah. One, you have corporates, yeah, who are sitting on the lowest leverage, yeah, or debt. the capacity utilization which is at higher level, which means at some point in time you are going to have investment cycle
Yes.
kicking in
Yeah.
from private side.
Yeah.
Okay. Second, you have banking system, which is probably the best that I have seen in my entire career, which means they are there to support the growth.
Yeah.
You always had consumption, which is resilient. It is not better than investments today, but it is resilient.
Yeah.
You have government, which is support you both on monetary side, on fiscal side, and non-fiscal side. So if you actually just step back and think about what government has done over last 5-7 years in India, in my view, they have done two or three things. First, they have done every reform that will help the economy to get basically more organized, more formal.
Yeah.
Whether it is demon, GST, corporate tax reductions, PLIs, everything that you look at it what it has led to is your tax collections have become more healthy and healthy, which is allowing government to replenish back it into economy through investments.
Yes.
So your first I said that the private capex at some point in time will start. The public capex is already underway.
Yeah.
The government's investments over the last 3 years, 4 years are almost doubled, tripled.
Yeah.
And they are going aggressive because the reforms that they have done to organize the economy have helped them to actually mobilize resources. Second thing that government has done is, and thankfully with the COVID and with the war, it is helping, is that India has been importing everything.
Yes.
We were importing energy, we still continue to import, and on top of that, we were importing all merchandise good, including the bottles like that you see on the table.
Yeah.
Okay, so the energy is something that you cannot solve overnight. So government has focused through all the reforms, including PLIs particularly, and import tariffs in certain sectors, on domestic substitution. So there is a huge import substitution and export ecosystem creation that is happening through PLIs. Thankfully, with the geopolitics that is there, the China plus is actually has accentuated. So when you look at all these factors, and on top of that, if you add that real estate cycle, finally after 6-7 years has kicked in India, you are in an environment where global is fairly complex and challenging, and you have domestic piece, which is probably the best that you have seen in a very long period of time. Of course, the best that you are seeing in domestic, to some degree, is captured in market. But typically, my observation is that your earning cycles don't break midway unless until something serious happens. For example, in the political event, suppose the establishment loses, or the war escalates in the entire Middle East. If that doesn't happen, the base case is you are in a business cycle, you are in a credit growth cycle. So while there will be volatility, there is little bit of upfronting of returns that has happened. We remain, from a 2-3 years, 5 years perspective, 3 years perspective at least, we remain far more constructive on market. Having said that, particularly in the broader market, which is mid cap and small cap, there has been a little bit of more upfronting in last 6 months as compared to what one would have imagined, because of domestic money and FIs are selling. So given that, one can stagger it, but the structural view probably hasn't been this strong, which we have for last 1.5 years, for before previous 5 years. The moot point is you are in a business cycle, you are in a credit growth cycle, you are in a earnings growth cycle. So if your credit growth continues at 15%, your balance sheets continue to re-leverage, your government keeps actually spending, and at some point in time, private capex and real estate cycle is already underway. If all those things remain, very, very unlikely that you will not get 13 to 15% earnings CAGR for next 3 years. If that is the case, there is no need to time if you're that horizon. But if at the same time, for near-term concerns and some of these upfronting of returns, if you are conscious or cautious, you can go in a staggered manner over next 6 months till the election happens. There can be volatility till the time you get into election. Plus, you get the final outcome, or at least inclination into how the Middle East thing is playing out.
Absolutely.
So that's how we are looking at the market.
Absolutely. I'll just add one more thing here, that we spoke about everything, but we missed an important IBC, insolvency and bankruptcy thing that this government introduced, which has actually helped a lot of, which has been a very good, which has been appreciated by the corporates like across the field. And also the infra side which you're talking about, I think especially on the roads that have been built and the speed which the government is spending, that has really created a very good thing. But there are few people who will say that कि अभी तो आपने government के बारे में बता दिया, you've spoken about this, but we have 3 important state elections coming up and also a run up to general elections.
Correct.
So we are in the semi-final phase of that. If you see the match right now, since the Cricket World Cup is also going on.
No, so there are risks. You are right, and that's why I said that somebody who's cautious and can't take volatility because of these events should actually look at staggering. Also because of upfronting that has happened in mid cap and small caps particularly. How we look at these events is at least the past evidence is the voter in India has been very, very discerning in terms of how it has voted for the state elections and central elections.
Absolutely.
Could be also to do with there are a lot of regional parties or state level leadership which probably in the opposition is also equally strong, and that's where at state level you might get mixed outcomes or even adverse outcomes. Even in 19 you got adverse outcomes. But when it's still the base case is when it comes to central elections, you don't necessarily have a very, very strong face in opposition. So we are working with the base case that of course in these 3 elections you might get even adverse outcomes and you will get volatility.
Absolutely.
You more than that, you have this global basically risk in Middle East, which if it extends to Iran and all, then it can really get murky. But for central elections, we see the same establishment returning, whether it returns with the same number of seats or lower majority, but we see the same establishment returning. And given that, of course, you will get into volatility for some period, and you might not get returns for 3-6 months. But are we worried about that? No, we are not worried about that risk.
Okay. So basically, viewers, you're listening to this and want to invest in the market, SIP is the way to
SIP
go,
is the best
way to go forward. And I think if you are a lump sum guy, you should keep some dry powder since the events pass.
Correct. There are 2 or 3 events which
Absolutely. Okay. So sir, my next question which comes here is like, we have seen small caps moving up. I think mid cap is also seeing a phenomenal rally in the market, at least from the lows of March 2023. At this moment, if I ask you about sectors, like what would be one sector that you are heavily bullish on and one sector that you are like, the valuation is peaking here and I would be...
So generally we are still more bullish on domestic cyclicals.
Okay.
Industrials, auto, financials, part of financials, not all financials. The hotels, hospitals, cement, these are the sectors where we are generally more constructive. Within these, if I have to pick, probably cement is something that is not very, very consensus, but there we are seeing the earnings upgrade cycle playing out, and there can be still sizable scope if the earnings keep getting upgraded the way they have come in just now in this quarterly result. In terms of negatives, I think commodities is something, given that the entire globe is slowing down. China is not recovering, US is likely to probably moderate from here, Europe is in doldrums. With this war, Middle East will also at the margin will have impact. Given that situation, the commodities, energy is a space where we still like remain kind of avoid not all names, but at least few more or less the broad basket.
Because I think commodities are one which are heavily influenced by the China factor as well.
Correct. So if you look at commodities and look back, of course this time around you have tighter supply chains. But in most of the commodities, China virtually consumes anywhere between 40% to 60% of the global demand, supply and demand. If that is the size of a player who's going into moderation, then it's very unlikely that you will have a good earnings profile of those companies over a period of time.
Absolutely. So basically, again, we play on the infra theme. Like we were talking about the government spending, public spending is already happening. We expect the private capex to come in. So I think infra and cement would be one of the best.
So not infra has different connotations. If you look at infra, fundamentally infra has railways, infra has roads, infra has in a way defense, infra has capital goods. When we are looking at all these spaces, typically except EPC, rest of the spaces is what we like, not the core EPC infra players. So that would be the way we would look at the investment side of the economy.
Okay. Talking about sector, there's one sector which has been has done a lot of news in past 2 years. That is the IT sector. So since the calendar year 2022, we have seen this sector being one of the worst which has been impacted. I think, and the new words which are coming, Chat GPT, AI, ML, everything. So do you see, what is your take on IT as the correction? Obviously, correction has been done. All the stocks are at their lowest in terms of their valuation. But do you see this be like? Do you see them correcting further, or do you see a stagnant period coming here?
So in IT, it has been mixed actually. If you actually frankly look at the sector, it has not behaved like a sector.
Yeah.
Unlike past this cycle, you had slowdown hitting the larger companies, but it has not still completely flown into mid and small size companies. Could be also to do with the profile of the or verticals where they are present. Uh, uh, we don't see earnings getting upgraded at least for another 2 or 3 quarters in that space. Our very simple thesis is if the entire Fortune 500 companies at the margin are moderating in terms of earnings, in terms of their profitability, in terms of their cash flows, the discretionary part of the IT spending will get hit, which is already visible in the large size IT companies. It looks like gradually it will start getting visible in the other names which are still not impacted. Of course, there will always be names which will specifically be part of particular space. For example, currently AR&D has not been impacted. So some of those individual companies will always be there, but broadly, we still see while the valuations have corrected, and at least in large cap valuation looks like at a level where they might not correct further, but we see earnings reversal yet for another 2-3 quarters, at least not for 2-3 quarters.
Okay, so basically right now it's a wait and watch.
Right now we are underweight and we continue to be there. We'll just watching it. These are great quality businesses,
Exactly.
But you're not finding any growth surprises as of now.
I can just rename it that the IT is missing the catalyst.
IT is clearly missing the catalyst.
Absolutely. Okay. Sir, you spoke. I'll just come back to your previous answer. You spoke about the run in the small caps that we have seen here. Right now, given a choice, and if I ask you to allocate funds into these multi assets, multi caps, so what would be your ideal mix for a large cap, mid cap, or a small cap thing? How would you?
So again, I would say something to which I earlier said, that basically it's not so much about the fund. The funds is just a solution that is available for investors.
Yeah.
It is more to do with the investors. If somebody is say 20-25 age, he has the appetite to sit through cycle, he can still by all means actually invest a larger part into small cap and mid cap and allocate smaller part to large caps. But if there is somebody who's basically doesn't have stomach for volatility, and given that there is so much of basically upfronting of returns that has happened particularly in small caps in last 6 months, we would advise them to actually tilt towards products where there is a sizable proportion of large cap.
Okay.
So flexi category, pure large cap funds, multi cap, these are the products where we think people should actually focus on from a near term volatility perspective.
Okay, so I'll just take you back to that question. So I've been an investor in Canara Robeco blue chip fund myself. So if I today someone like a 35-year-old is asking you to pick two funds from Canara Robeco's basket, so what would be your advice?
Oh, that's very difficult, but I would say Canara Robeco multi cap and Canara Robeco blue chip. Those are the two funds that I'll pick.
Okay. So viewers, the two funds that you can see from Canara Robeco's basket, that is the blue chip fund and the multi-cap fund. Sir, moving ahead, we have spoken about caps. Now let's talk about assets. And I know you're the head of equities here, but ideally people say that you need to have a mix of equity and debt, like fixed income in your portfolio. And given right now we are seeing a lot of good these that side is quite attractive right now with the interest rates and everything going up. So what would be an ideal mix here, and also like in terms of the percentage, and also a bit of commodity that you can talk about, the gold, silver?
So as I said, we are not expert on commenting on the fixed income or gold, but this is just my personal opinion, not my organizational. Style.
Yeah, I know, because I clearly said that you are head of equity. So
just if I have to give my thoughts, I think yes, there are opportunities in fixed income also today, particularly for investors who are conservative and okay with probably 8-10% return. and have a 2-3 year horizon, because at some point in time you'll get 50-100 basis point of decline in interest rates, which means you're going to get a little bit of capital gains.
Absolutely.
And your current yield of the portfolio could be 7.5, 8%, depending on the portfolio that you are taking. At least 7.5%. Even if you take 10 years G-Sec, you're getting 7.3.
Yeah.
So from that perspective, for conservative investors, if they're worried about the risks of upfronting of returns, election, the war that is happening, little bit allocation on the fixed income side is not a challenge. Gold is, I think, commodities. We have no comment on that.
Okay.
Yeah.
I think every Indian anyway loves gold, so वो तो
Indian, anyways, every Indian has real estate and gold. He doesn't need advice on that.
Exactly. Every Indian has a expert on gold in their own house, so we can see that. Sir, I've spoken about buying. I don't want to get into how to pick stock and all those stuff, because a lot of people have already spoken about this, and we have, like, in general, that's the focus area. But my focus area right now would be, when do you decide to sell something? Because buying is good, but to exit at the right time is also a very important factor for a fund manager. So I want to know that when do you decide to exit a certain stock?
So typically, two things basically: you trim or you exit. Okay. Thankfully, if you get into good business, you never want to exit it, as long as. But if it gets too expensive on the basic valuation parameters vis-a-vis the earnings growth that is projected for next 2-3 years, typically first leg of action is you typically tend to trim it.
Okay.
If something becomes really very expensive and earnings are not playing out, of course, then you exit it.
Right.
That is second. And third is basically, which is your direct question, where do you exit? If there is any question mark that comes on the capital allocation, if there is any question mark that comes on the competitive intensity of the sector, if there is any question mark that gets developed on corporate governance of the management, then you just plainly, or fourth, if there is a sizable earnings downgrade vis-a-vis valuations that you did not anticipate, if any of these things happen, then you plainly exit it.
Right.
So those are the exit points. Typically, the first point is trimming as a regular action in a lot of stocks. But if the second bucket happens, then you exit them.
Absolutely. So that is one of the part. Sir, I'm coming to the last part of my questions. Like, you spoke about two eras, the pre-COVID and the post-COVID. The post-COVID area is quite interesting because a lot of people have come in, and a lot of people have come into the FNO segment. And SEBI's report says that 90% of people are losing money. That
95, I guess.
Yeah. And obviously, 90 are losing, and 95 are not making money. They're not even beating FD. That is what the report says. So a lot of young people are here, and I've seen a lot of people who are in the 40-year bracket also. Since that work from home culture came in, a lot of people started trading. So what is your advice to somebody who's trading in the market? Options, especially.
No, I think the answer is very, very. If you have spent time, 3, 5 year, 10 year, in understanding how the options market work or how trading works, then by all means you should trade. But if you're not done that, and just based on last 2 years, because the market has been unidirectional, even if you have made some money, please don't live under the wrong impression that you are intelligent or you understand the market, that's why you are making money. You'll get surprised very, very quickly. So the focus should be more on something that will help you to create wealth.
Right.
If you can actually have a good asset allocation plan, good financial goals, and invest behind them in terms of allocation to equities, fixed income, gold, whatever asset classes are, real estate, and follow it properly, probably you'll be far better off than just trading in any of futures or options, because the data clearly indicates that if there are only 5% or less than 5% people eventually make money, then you really have to be good at it to do it. So the advice is just focus on what your core is, which is whatever your business or your profession is, and on the other hand, parallelly have your financial goals and actually invest behind those financial goals properly, rather than actually dabbling into market, whether it is direct equities or direct basically futures and options in terms of trading.
One interesting thing you said, that wealth यहाँ नहीं बनेगा. You said wealth बनाना है तो invest in gold, real estate or some stock. आपने clearly कहा है कि options will never make you wealth, and people who are listening, you guys get into option because you want to get rich quick, but from a veteran, he's saying you will never make wealth here means you're anyways going to lose that much money someday or the other.
Yeah, I mean, I've been in market for almost 20 years now. I haven't come across many people who have become rich by trading. There are, of course, but it's a low percentage, probably even less than what SEBI has quoted.
Exactly.
So, or regulator has quoted. So, please have a financial plan, invest in mutual funds, invest in equities if you are actually doing research. But go about it in a more basically scientific manner and have appetite to add to it when actually markets
Absolutely.
correct.
Absolutely. So these were my questions regarding the markets and everything. One last and we wrap it up is बहुत markets क्या देखें? What do you do when you're not tracking the markets and what do you not when you're not looking at the screen tracking news, stock किधर गया, market किधर गया, nifty किधर गया? What do you like to do outside the market?
Well, generally, I spend whatever time which is sometimes we get apart from what we do with either kids. I still have young kids, or basically reading or listening to music. Reading is getting lower and lower now because you anyways read a lot.
Yeah.
But still, reading and music is something that I spend time on.
Okay. So, viewers, that was it from our end. Thank you so much, sir. It was an absolute pleasure hosting you, sir.
Thank you so much.
Thank you so much, sir.
Please note, mutual fund investments are subject to market risk. Read all scheme-related documents carefully.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.